Okay, we are on. So, good afternoon, everybody. I'm here with my partner Fan Liangxia. He is in Australia and I'm in Singapore. And it has been a lazy Sunday, and we are both at home because of the COVID situation. So we decided to just catch up with each other. We haven't spoken to each other for some time, and we decided to just discuss a couple of the businesses that we are looking. So Panliang, which business are we going to discuss first today?
I think we'll start with 51 jobs.
51 job, yeah.
There are a couple of companies that release earnings these few weeks. All of them are pretty interesting. Yeah.
Okay, yeah, I know 51 job is your favorite. So for the benefit of our viewers, can you just tell them what 51 job is and what do they do? What do you like about the business?
Yeah, sure. So 51 Jobs is actually a leading HR services company in China where they provide online recruitment service. So think about those job portals that when you want to apply a job, you go to the job portal to screen through the jobs and apply for them. 51 Jobs does that as about half of their revenue. On top of that, they also do provide some other additional human resources services. Think about payroll, compliance with taxes, trainings, or screening of CVs for the companies. 51 Jobs does that too. So these two services are highly recurring for the company, and China is still pretty behind in terms of doing job recruitments online. So there's a strong tailwind behind this industry that 51 Job is leveraging on. Yep.
So how were the results that they announced? Can you just give an overview of the results that they announced?
Yeah, sure. So they released their results earlier this week, and because most of their clients are small and medium businesses, as expected, are facing uncertainties where economics are slowing down about 13%. So it drops from last year quarter one. It was 900 million renminbi. This quarter it was 790 renminbi million.
And it was
both their online.
It was entirely because of this the coronavirus related slowdown in recruitments.
Yep. So their revenue is mainly derived from two segments. The first one is, as I just said, from the online recruitment services that got hit less because companies are just putting on hold their hiring plans and also slashing some of their recruitment budgets. So that got hit. The other segment that got hit even more is on the other HR services, where those revenues include some revenues by providing trainings for the companies. So think about like training seminars, in-person events, and also recruitments on campuses where they go to schools and universities to hire, to hold job portals and job fairs and hire people for the companies. And because of the corona situation, these activities couldn't be held. So the revenues basically just disappeared by a lot. But they are slowly seeing that things are being opened up again in China. So
yeah, I just read the Shanghai Disneyland just opened up, and it seems on the opening day it was completely sold out. So
yeah, people are waiting.
So before we get into the details and before we discuss uh, some of the points which I had about 51 jobs, do you have any picture that you can share to give our viewers some idea about how they have been growing or how they have been growing their earnings, and any historical slide? Do you have anything handy? I remember you had shared something, so if you want, I can.
Yeah, let me try to see whether I can pull it up.
Okay, while you're looking for the slide, I was looking at a picture which is slightly old, but when we were researching 51 job, and this is the picture which actually tells us a lot about the business. Let me just share that. Now, okay, so here just a bit of a background. This is for the benefit of our viewers. Now, Fan Liang is going to, once he finds his picture, he's going to show how this company has shown very healthy growth over the years. But often growth can be a very deceptive thing to look at it in isolation, because uh, and this is also something that Warren Buffett has very beautifully explained, and that's where I also started looking at growth slightly differently. That uh, a company which is investing a lot of capital in the business, I mean, they will see growth because of the pure compounding. This is just like a bank account which generates some interest, but if the interest is not taken out, then the interest gets reinvested, and the next year the interest is even higher. So that's the reason why we need to look at, when we think of growth, we also need to look at what is the capital that is going back into the business. Now, the beautiful thing about a business like 51 Jobs is, first of all, you can see from the screen that it has a negative working capital. And the yellow bars, they show the total capital needed to run the business. So here, we are defining total capital as the net working capital plus the PP&E. And you can see that 51 Jobs not only runs on, not only does it not need any capital to grow its business, it actually releases capital as it grows. So that's the beauty of a company like 51 Jobs. However, and this is something which we have been discussing for some time, is that uh, the capital which 51 Jobs is releasing, obviously, they must be generating a lot of cash. So what is happening to that cash? So, Fan Liang, what is the current cash balance that they have on their balance sheet, and what are they doing about it?
Yeah, sure. I actually have some slides from
Yeah.
the company now, which I can provide some background on the revenues, and I can come back to this cash point, which is
Yes.
massive. Okay, yeah. So this is basically some slides from the company, and as you can see here, it shows revenue all the way from 2004, and it has just been increasing every year from about 480 million renminbi in 2004 until last year it was about 4 billion renminbi. And we can see that it's driven by half of it is coming from the online recruitment services, which make up about 2.5 billion. And then there's also another 1.5 billion coming from the other HR services that got impacted even more. So coming back to the cash point, as Rupam said, what we like about this business is that it is highly cash generative because of its negative working capital situation, where for the online recruitment business, 51 will collect money from the customers first for them to be able to advertise on their job portal. And then on the other HR services where they help the company to do payroll and pay taxes to the government, they also collect the cash from the companies first before they pay to the government. So that gives some negative working capital and float. So we can see here there's one chart where the blue dotted line is the net income for the year. And then if we compare it to the red line, the cherry red line, which is the net cash provided by operating activities, you can see that the operating cash flows is always much higher than the revenues. And
I
that's just coming
absolutely
from,
love businesses like this. This is something which I always compare, which is how are the operating cash flows growing as compared to the net income, and businesses which are growing their operating cash flows at a rate which is faster than the growth in net income, and that is not because of that is not a short-term thing where a business might grow their operating cash flow by liquidating some inventory or uh, working capital. Here, it has been happening what since 2008. So that's a very healthy sign. Yeah, sorry, go ahead.
Yeah, that's the point we like about 51 jobs. It's just crazy. It's just churning out all the free cash flows by so much, and it doesn't need any debt or new capital funding to fund it. So based on last year, they were generating about 1.8 billion RMB of cash flows, and that is coming from a net income of about 500 million. That might be a normal year, but you can see that there's so much negative working capital going on here that is funding the business. So because of this cash flow just coming out from this company, the company actually has a massive amount of cash on its balance sheet now. So this bright blue line is the cash that they have on hand, and they don't have any debt. The only debt-like instrument that they have is they used to have a convertible
I was
bond.
just going to ask you about that. I mean,
Yeah,
if the company is generating so much cash, I remember a couple of years back, they had this convertible instrument. So why did they need to raise that? Was it specific to any acquisition? Can you give some idea to our viewers?
yeah. So I think that was still a bit of a mystery to us. And what I'm guessing is probably they are getting USD notes in the US capital markets, so that because they generate most of their revenue in renminbi, they might need some cash flows from USDs. That's why they do it. But
Okay, that's
probably there might
possible.
be other reasons that we are still not sure of. But I've actually seen quite a lot of the US listed Chinese companies doing this, and we are still investigating further what's the reason for that, given that it's obvious that they don't need the cash if
That's
you
possible. That's possible.
disregard the currency. Yeah.
And you remember, Fanya, sometime back on our forum, I was talking about options and the different use of options. And I remember in case of 51 jobs, they actually, I mean, I gave the example of a convertible note, and one way of making a convertible note non-dilutive is by using options. And that is exactly what 51 jobs had done, I remember. So they had
Yeah.
bought some call options, which was done in order to uh, not dilute the existing owners. Anyway, sorry, you go ahead with the with the cash.
Yeah.
So right now they have how much? They have this is in renminbi. So in US dollar terms, this is what 1.5 billion, 1.6 billion dollars of cash.
Yeah. So as of December last year, it's about 1.4 or 1.5 billion US dollars. Now, yes, this quarter it has grown even more to RMB about 11 billion. So that's about 1.6 billion USD. And its current market cap is about 4 billion USD. So that's about 40% of market cap in cash and net cash, because they no longer have any debt. And
Okay.
the convertible notes have since converted into shares. So it's really zero debt on their balance sheet. So that's a massive 40% of your market cap
Okay.
just in parking and cash.
So now my question is, and this is where I think there is a divergence that happens between your thought process and mine. And for our viewers, I would like to say that just because Fan Liang and I we are partners doesn't mean that we need to agree on everything. In fact, the 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 great thing about the two of us is we keep discussing and we actually debate a lot. I mean, that's something that happens behind the scenes. When we talk, we debate a lot. We have, the difference in opinion. But the best part about working with each other is we also respect each other's opinions, and at the end of the day it's always the superior logic that prevails. So there is absolutely no ego here, and it is this huge cash balance that 51 Jobs has on their balance sheet. That is something which has been bothering me for some time, because at the end of the day, if I'm a shareholder of 51 Jobs, purely from the operating business, I should be very happy the way the business is doing. But unfortunately, my long-term returns would not only depend on the operating business, it would also depend upon their capital allocation strategies. And I would like to know what are their capital allocation strategies for this 1.6 billion dollars. They have the option of giving out dividends, they have the option of buybacks, or they have the option of uh, acquiring some other businesses. So, what are your thoughts, Fanlian, on these
Yeah.
fronts?
So yeah, I would say capital allocation is definitely very important, and I'll say 51 Job is a pretty interesting case where I'm not fully convinced on the capital allocation strategy now, but I'm still giving it a second chance to monitor further, and I'm still very much attracted to this company because of its strong cash flows from the core business, just churning out so much cash, driven by a long tailwind at a high growth rate. So, but yeah, let's come back to the issue of capital allocation. So, as a backdrop, as we've seen just now, the company is sitting on top of about 11 billion RMB dollars of net cash, and its operating income seen by the yellow line is actually about recently about 1 billion something RMB. So that's almost 10 years of operating income sitting on its balance sheet now. And now if you look at these charts, you can see that there are a few more lines that are associated with capital allocations. So first one is the company has never issued any dividend at all since its IPO. And we have actually communicated with the investor relations to see what are their plans for their massive cash. And the answer given back was on dividends, there are certain regulations and approval that they need to get from the government to move the cash out. And also there'll be some withholding tax implemented on these dividends. So far they haven't been giving any dividends. And the second option of allocating your capital will be to buy back your shares. So this will be denoted by, let me see, by the red line over here. And as we can see, during the past 10 or 11 years, they have only been buying minimal amount of buybacks, where the largest buyback was seen in 2014 and 15 of about 150 million renminbi in each year. But that's so small compared to what their operating cash flows amounts are. And the third way they can allocate the capital is to reinvest back into the core business. But as we have just said just now, the
They don't
company
need
basically
to.
doesn't.
Yeah, they don't need any capital
Yeah,
in the core business. In fact, the business throws out capital. So,
yeah,
this is a very unique business. This is a very unique situation. 51 Jobs has always been on my watch list, and I don't really spend much time looking into it, because I know, Panya, you are doing it, and I trust your judgments. But this is something which has always puzzled me. So on one hand, we have an extremely strong operating business, which I would absolutely love to own. But on the other hand, here is a capital allocation strategy which I absolutely do not like. And for new investors, the long term return of a business, and by the way, here, people who follow us, they know that we care very little about what's going on in the stock market. We focus on the operating results of a business. And uh, of course, if I can buy a stock at a very low multiple, and if there is a multiple expansion, then that boosts my returns. But I just consider that as a bonus. So I would like to keep that away for the time being. So where else would my return come from? It would be the growth in earnings of the business, which will grow the intrinsic value of the business. And and apart from that, it would be the growth from the capital allocations, which can be in form of dividends or share buybacks, or if they do, value accretive acquisitions. Now here, as Fan Liang just said, that they feel there are some constraints in giving out dividends, which is okay, which is understandable. But when it comes to share buybacks, I personally feel 51 Jobs uh, has had several opportunities where the buybacks could have been value accretive, because the share price was actually depressed at different points of time. And it's actually not the case that Chinese companies who are listed outside China, they cannot do buybacks. I mean, we have seen several instances, like for example, JD.com listed in the US, uh, initiated, that has got approval and has initiated a buyback. Tencent has been buying back. They're listed in Hong Kong, so I'm sure there would be a way. And see, my problem with, especially because this is a Chinese company, there are certain risks which we cannot ignore. Like for example, all these Chinese companies have this funny VIE structure where you're not exactly owning the company. You're what you own are basically a bunch of contracts which entitle you to the earnings of the company, and that's how these VIE structure work. So I would feel much more comfortable if these businesses, these Chinese businesses, at least uh, have a robust capital allocation strategy, because without that, we are solely dependent on the growth in their share price, which would be a result of the growth in their intrinsic value. And if they're unable to reinvest their earnings into the business, the earnings growth will be very, very subdued, because it's really small, and their return on equity clearly is suffering. So, so that is my issue with them. And now coming to acquisitions, Fanlia, you can kind of give an update to our viewers on some of the acquisitions that they have done in the past.
Yes, yes, sure. Yeah, so I totally agree with what you just said. And just before I go into acquisition, just a few more points to add is that I think this company is growing its core business very strongly without any capital, and that could lead to an increase in intrinsic value, which is good for the shareholders. But I think ultimately, the shareholders must be able to access all this cash from the business to translate that into increase in intrinsic value. And that's the part that I have slight concern now, where if they can't distribute out them as the ways of channeling that cash back to the shareholders. And that's the part that I'm still monitoring. So coming back to M&As on acquisitions, this is the activity that, based on our communications with the investor relations, that they mentioned the reason why they are still holding on to so much cash is that the current economic situations are uncertain due to COVID situations. So they want to have more cash buffer, and they are also reserving all this cash for potential future M&A activities, which they started in 2015. So if you look at this chart over here on the green line, the green line basically shows the amount of cash that is spent on buying businesses. And then there's also another yellow line, which is tracking closely the green line. The yellow line basically just shows the total amount that relates to the deals for acquisition of those business. And the difference is just the green line shows the cash amount fork out for the deal, and the yellow line is the whole consideration for the deal. So
The
if you buy
balance
a
is
business
stock.
and it's, yeah, some of it is stock, and also if the business that we are acquiring have net cash inside their balance sheet.
Ah, okay.
When we buy, we pay less cash. Yeah,
Okay.
it nets out each other. Yeah.
Understand.
So
Understand.
yeah, so you can see that they have done some acquisitions from 2015 to 2018 and nothing in 2019,
Yeah,
but the amounts are still pretty small.
my only problem is, I mean, it hardly moved the needle. You know, their cash balance is so huge. So, which means, and I saw the email which their IR sent to you. They seem to be quite responsive, right? I mean,
Yeah,
they respond to your emails, and I saw that. But the only problem is, for me to believe that. This will be a meaningful capital allocation strategy. For that to happen, and if I think like a long term owner, which means over the next 10 years they have to keep doing acquisitions. That is number one. They have to keep doing acquisitions at an accelerated pace, which is much more than the rate that they have done in the past. And those acquisitions all have to be value accretive and have to be meaningful acquisitions. Now, I think in terms of base rate probabilities, and knowing,
yeah,
that historically most of these non-core business related acquisitions, they somehow do not work out. I mean, what are the chances of all the three happening? That is, continuous rate of acquisitions, more number of acquisitions, at an accelerated pace, and those acquisitions all working out to be value accretive. I think the chances of that happening is very, very low. And that's the reason why, I have always in the past hesitated in pulling the trigger on 51 job. I will be very happy to see the, if this changes. And funnily, what I find surprising is, till now, the earnings calls that I have listened to, I have at least I have not come across a single analyst asking them the question about capital allocation. They all want to know the color on the next quarter's earnings and all that rubbish. No one, not a single question I have come across about their huge cash balance, as if that's something that doesn't exist in their mind. And
yeah.
this is something which worries me. Anyway, what I think we should do is, this is definitely a very interesting business. So let's keep an eye. Let's watch them very closely over the next few quarters, or maybe the next year or so. As I mentioned the other day on WhatsApp, I'll be very happy to see if 51 Job, makes an acquisition offer to Upwork. It will be synergistic, and I think it can be a great thing. But as you mentioned, that in China, I don't think they think in terms of remote working so as much as in the rest of the world. Is that true?
Yeah, I think so. They mentioned during their earnings call that they are not seeing such much demand from the companies, even though during the COVID situation, such demand was increased, but most companies are still using them for non-essential services or non-core services that are not that important to the company's long-term sustainable growth.
Okay.
And
All right.
just one more point to add,
Yeah,
sorry,
sure.
on the point that you're making just now, I think I agree with you that it is not possible or practical to rely on future M&As to allocate those capital in the long run. And I'm just waiting to see what they are planning to do with their cash balances. Even if they just distribute out all as dividends, I think it's still a pretty good value to shareholder just
Yeah,
because of
absolutely.
the underlying dynamics for the core business. Yeah. So I'm just waiting for that there to happen.
Absolutely. And frankly speaking, even if there is a withholding tax, I mean, the withholding tax, would be less than the withholding tax that we have to pay on dividends from US companies. And there is there is always an opportunity cost, right? There's a huge opportunity cost for shareholders, because
Yeah.
that cash which is lying there, that's not earning anything for them. So,
Yep.
it might still make sense to maybe, allocate more towards buybacks and the rest towards dividend. Anyway, so let's keep an eye, and we will keep updating our viewers, maybe 6 months down the line or a year down the line, on how this goes. Okay, thanks a lot, Fan Liang. If you are interested in our deep dive research on the different aspects of the business, then I would encourage you to register for free on moneywisesmart.com/research, and you will be able to access all the subsequent videos where we cover each and every topic in great depth, as we have been doing for all our companies. And we also invite you to join our Facebook group. The link is provided below. We discuss great businesses there in the community, and also we often share videos discussing interesting investment concepts. So do join, and if you have enjoyed this video, do give us a like and subscribe to our YouTube channel, and feel free to share it with your friends. Thank you very much for your time.